Looking for the best investment strategies to grow your wealth in 2023? With so many options available, it can be overwhelming to know where to start. But don't worry, we've researched for you and have compiled the top 10 best investment strategies for the year ahead. Whether you're a pro investor or just starting, these strategies can help you maximize your returns and possibly achieve your financial goals. So let's look in and discover the best investment strategies for 2023. Number 1. High-yield savings accounts. Best for investors with short-term financial goals. Risk low. High-yield savings accounts can offer returns that are 20 to 25 times higher than the average savings account. These accounts are also backed by the Federal Deposit Insurance Corporation, or FDIC, insuring deposits up to $250,000 and making them a safe investment option. In addition, high-yield savings accounts allow for up to 6 monthly withdrawals. While they offer higher returns than conventional savings accounts, they may not be the best option for long-term wealth goals. Instead, they're an excellent choice for saving up for specific goals such as a car or emergency fund. Number 2. Certificates of deposit. Best for risk-averse investors who need money at a specific future date. Risk low. A certificate of deposit, or CD, is a type of savings account that offers higher interest rates than a regular savings account for a defined period. The length of the CD term determines how long you must keep your money in the account before withdrawing it without penalty, which can range from months to years. FDIC-insured CDs are considered low risk, but the interest rates offered may limit your earnings. Additionally, your money is locked in for the duration of the CD term, which means you could miss out on higher interest rates. To take advantage of better rates in the future, consider using a short-term CD and then reinvesting when it matures. While CDs often offer higher returns than high-yield savings accounts, they do require you to lock up your money for the term of the CD. Number 3. Series 1 bonds. Best for risk-averse investors who want protection and stability in their portfolio, especially during inflation. Risk low. The U.S. Treasury offers a low-risk savings option called Series 1 bonds. These bonds are inflation-adjusted, meaning that in addition to the introductory interest rate, the Treasury also pays an inflation rate twice a year. Series 1 bonds can earn interest for up to 30 years at a fixed rate, and the additional interest is calculated using the inflation rate. Series 1 bonds can be purchased annually for up to $10,000 and yield interest for 30 years. If redeemed before 5 years, the holder forfeits the past 3 months of interest payments. However, after 5 years, the bond can be cashed in without penalty. Series 1 bonds are considered a secure investment and are often used as a hedge against inflation. Number 4. Money market accounts. Best for risk-averse investors who want access to cash. Risk low. A money market account is another federally insured, interest-bearing savings account that is similar to CDs or high-yield savings accounts. However, money market accounts offer additional options for withdrawing funds, although you're still limited to 6 per month. For those seeking a low-risk investment that still allows access to cash when needed, a money market account is an ideal option. They function effectively as a short-term savings vehicle, similar to a high-yield savings account, and can be used for near-term expenses like a car or for building an emergency fund. Number 5. Governmental bonds. Best for risk-averse investors finding fixed income and less volatility in their portfolio. Risk low. An illustrated chart can help you choose the best high-yield bonds by dividing bond investments into 3 groups. When you purchase a government bond, you're essentially lending money to the government to help pay down U.S. debt or support infrastructure. Fixed income securities like bonds pay investors interest annually, and investors receive the bond principal at maturity. Government bonds are among the safest investments since they're backed by the U.S. government. However, the returns are typically lower than those of stocks, so government bonds may not be sufficient for financing your retirement or long-term wealth goals. Number 6. Municipal bonds. Best for risk-averse investors who seek to preserve their portfolio while generating fixed income. Risk medium. Cities, counties, and other state government agencies issue municipal bonds, commonly known as munis, to raise money for public works initiatives such as constructing roads or schools. Municipal bond interest is often exempt from federal taxes and, in some cases, state and local taxes as well. Municipal bonds come in 2 primary types and can be structured in various ways. General obligation bonds, or GOs. These are government-issued bonds that are not supported by money from a specific project. They may be supported by public funds or real estate taxes. Revenue bonds. These bonds are backed by income from a particular project, such as a highway or toll road. They use the revenue from the project to pay back investors. Since the payoff is based on the success of a particular project, revenue bonds often involve higher risk than GOs. Nevertheless, compared to corporate bonds, municipal bonds are still less risky overall. Municipal bond values fluctuate in response to changes in interest rates, like other bonds. That means if interest rates rise, you may lose money. However, they remain among the most secure investment options with favorable tax treatment. Number 7. Corporate bonds. Best for conservative investors who find a slightly higher yield than government bonds. Risk, medium. Similar to government bonds, corporate bonds are those issued by businesses instead of governments. Companies may issue bonds to raise money for operations, and there are two types of bonds. Investment-grade bonds are regarded as a better quality investment since larger firms often issue them with a longer track record of reliable earnings. Since they are more likely to be repaid, there is less risk associated with them. Companies that have a poor track record of consistent profitability issue junk bonds. As a result, they carry a higher level of risk than investment-grade bonds, although the returns are frequently more significant. Risk-averse investors seeking a slightly higher return than government bonds might choose corporate bonds. However, it is essential to note that even though they are less risky than equities since they are FDIC insured, unlike government bonds, they still carry additional risk. Number 8. Dividend-paying ETFs. Best for young investors with small capital to invest. Risk, medium. ETFs aggregate investor money to buy a basket of equities similar to individual stocks. Young investors with a long-term investment view should consider ETFs. S&P 500 and NASDAQ 100 dividend-paying ETFs allow investors to purchase high-yielding equities. ETFs are appropriate for novice investors and those seeking yields. Stash simplifies dividend ETF investing. Since ETFs track an index, they provide straightforward diversification. Similar to S&P 500 or NASDAQ 100 index funds, the poor performance of one company may be offset by the strong performance of another. The holdings of an ETF determine its risk, so it's important to know what they are. The best high-yield investments are determined by your time horizon and risk tolerance. Investors with decades until retirement can take greater risks and earn bigger returns on certain assets. Number 9. Mutual funds. Best for investors who want instant diversification without having to research stocks themselves. Risk, medium. Mutual funds invest in stocks, bonds, and other securities, much like index funds. However, mutual funds strive to outperform the market, while index funds attempt to replicate stock index returns. Professional fund managers actively manage mutual funds and choose their equity holdings. This active management increases the fees charged by mutual funds, reducing potential returns. If you can find a fund manager who consistently beats the market, mutual funds can be a high-yield investment. However, gains are not guaranteed. Actively managed mutual funds can underperform, making them riskier than index funds. You risk losing money if you pay more for a mutual fund that does not perform well. Number 10. Dividend stocks. Best for long-term investors seeking immediate positive returns or retirees looking for cash flow. Risk, medium. Dividend stocks provide bond-like recurring payments and the potential for a considerable stock market gain. A dividend is a percentage of a company's earnings sent to stockholders, often distributed once every 3 months. While dividend stocks benefit all investors, those who need immediate income yet have the patience to hold their investments for a long time tend to favor them. Although dividend stocks often do not increase as rapidly as growth companies, many investors prefer them because their consistent cash dividends offer stability. You may purchase dividend stocks from a wide range of businesses, but if you're buying individual stocks, as opposed to stock funds, you should conduct preliminary research to lower your risk. Search for businesses that have grown consistently rather than those with the highest yield. Thank you for joining us on our journey through the world of finance. Don't forget to subscribe to our channel and hit the notification bell to stay updated on our latest videos. Until next time, keep living your best life and indulging in the finer things.